Hi there. Thanks for tuning in. Today we're going to be taking a look at B&M European Value Retail, and we're going to be doing an analysis and valuation of the stock to see if it's a potential investment opportunity. This stock trades in the London Stock Exchange, so if you're a British viewer or if you have access to ADRs through US markets or through whoever your broker is, if you're from anywhere else in the world, this will be a very interesting opportunity. Now, if you like these kinds of videos, don't forget to like and subscribe, and also feel free to comment down below if you want me to look at any stocks. This is a viewer request, and I love doing requests if they look interesting. So, without further ado, let's get started. So, first of all, what is B&M? They basically are like a value store, supermarkets, etc., where they have generally lower cost compared to others. So, for the first half of what is their fiscal year 26, so that starts in the second half of the year, their revenue is up, their growth is in the UK is 0.1%, EBITDA is positive and steady pretty much. So they're trying to right now be in a bit of a transitionary period. So they have some openings in the UK, some in France as well, which seems to be their bigger growth market right now. And they have four focus areas here where they're drifting. So they talk about price, promotions, range, and availability. So where they're drifting is that they're focusing on basket values, not their lines, not competitive on key lines and the customer value perception. So they're trying to get back on track here, where they're trying to position themselves better versus supermarkets, be better value in your total basket generally. Um, and have the best price amongst discounters. So they compete on price, which is good when it works, but also expect tight margins if you're competing on price. For promotions, they want to determine manager specials centrally instead of before they were kind of doing it locally and stuff. So that's a change that they're doing. Seems like it didn't work to do it locally. Now they're doing it in general with a given framework and with given sort of criteria to do it. The range. So before they had a bit of SKU control locally. It seems like they're reducing the SKUs, clearing old stock, etc. That should make them leaner. That should make them have more profit for the fewer items that they focus on. And then here, the sales culture apparently sacrificed the store standards. So they basically need to refocus there to drive sales, less on standards there, and embed the best practice replenishment. I don't know what that means, but still, they're basically saying we failed a lot lately, and we're going to have to do it better, you know? So that's important, and we like to see that as kind of self-reflection here. To get back to basics, their basket price benchmarking for total basket and lines, basically they're saying, hey, we are going to compete on price. We're going only very few retailers are going to have higher price for the total basket here. Um, the promotions here are going to be interesting. You see stores doing stuff for events, Halloween, Christmas, back to school, etc. So, sometimes that can seasonally be very appropriate. And they're moving this from price, promotions, range, availability. Eventually, that also is going to give further data and eventually maybe e-commerce and loyalty plans as well as the France acceleration. So you kind of see their vision outlined here, at least. If we talk the numbers, however, generally they're a pretty good revenue grower. The revenue growth has slowed a little bit. Perhaps it would even stay stagnant or go down a tiny bit if the execution is tricky with all of this pivoting that they're doing and if they're competing on price. But they tend to be a very consistent grower throughout the years, even double digits. It's very impressive, actually. Their gross margin also very steady to growing a little bit. Same with their operating margin and their return on invested capital, very consistent at the very least in the double digits, fairly consistently. If we look at their free cash flow to revenue ratio, how much of revenues is turned into free cash flow? That averages out at 12% over the last 5 years. I'm going to say let's stick with a 10% number because I'm going to plug that into my model that we're about to look at. So I'm saying 10% for estimated revenues are going to be turned to free cash flow. They're going to keep growing, and they're going to grow pretty consistently at about this 3% rate, and they're going to do that in perpetuity. My required rate of return is 11% per year. And if we divide that and those numbers in the discounted cash flow model by the total number of shares out, we get £7 and 12 pence. However, if we subtract the net debt out, which they have quite a bit of it, although not an alarming number, we would get £4.93. So that would be with the net debt included, 11% required of a return and 3% perpetual growth rate compared to where it lies right now. Now, this is in pence, so actually, if we move the decimal two over, you would have £2.17 basically that it's trading at. That is quite undervalued compared to here. And that's very interesting to me. So, as you'll see, it moves very cyclically in general, it's in all of its history being public. It's hit this point before. And it had value that is way above what I actually think is fair value here. It's hit that six number before, or mid fives in terms of value. So I think it's an interesting opportunity. Don't even look at the dividend yield. They may cut it if they're not doing that great or if they really want to refocus. But it is interesting that they are paying you quite a fair bit to just own it. So that's very interesting to me. At this point, I'm looking at the London Stock Exchange and saying, hey, there may be undervalued things here. So, I mean, on paper, it looks quite undervalued, though this can be said about UK stocks in general, oftentimes, and finding the winners in these requires extra scrutiny. When a market in general is looking depressed, um, sure, all of it will appreciate, but you want the winners. You don't want just a reversion to the mean. You want to see which opportunities are going to be a 2, 3x. So you may have to look at a general basket of UK stocks and look at all those individual ones and see which ones are the best there. They have some diversification by going to France, but both of those countries are in somewhat fiscal trouble. That could have some consequences there. The numbers also look quite stellar in terms of ability to keep growing and keep margins steady, though they do need improvement in a business where margins are usually quite tight. The risks come from lower than expected EU growth and the execution of their newer priorities. So is it worth taking this risk? I mean, very possibly yes. It's rare that we see such undervaluation, and in general, UK related assets seem to be at least somewhat undervalued. And if nothing changes drastically, you could actually enjoy riding one of these waves. If you bought down here in 2020, you probably enjoyed selling in 2022. If you bought down here in mid 2022, you could probably have sold in 2024 and been very happy. So, it's just about entering at the right time, at the right value, and for the right businesses. So, look outside your home country and keep the high standards. Understand what the business is, how it makes money, keep the standards there, and you may find some little gems. And I'm going to keep looking at B&M and seeing if it's worthy to add to my portfolio. But in general, just look at other markets, see if they're undervalued and so why, and try to pick out the winners there. With that said, thank you so much for watching. I hope you learned something in this video, and please like and subscribe if you enjoyed this. Thank you so much once again, and have a great rest of your day.